Another week of all-time highs. Guys, my name is Hamilton. I'm here with the Trading Initiative, and in this week's Markets in Focus, wrapping up January 26, 2024, we're going to talk about all of the good stuff that happened and potentially some of the bad stuff we should start planning for. Yeah, stick around and we're going to talk about some potential pullbacks coming in the market. But let's go ahead and start off here with this intermarket analysis. Let's look at everything that moved the most important parts of the market. Check out oil up 5%. This week, finally, oil moving. The Q's up 3.23%, growth up 2.99 in particular. The Russell 2K finally showing a little bit of vigor, but not out of the hole, up 2.82. Commodities up, emerging markets up, copper up, the S&P 500 up 1.12%. As a matter of fact, the only thing that's down right now is Bitcoin, but that's okay because that's not the only thing we have to trade. Even bonds are showing a little bit of something. Finally, we'll talk through that in a second as well. Generally speaking, it's been a pretty good week for the bull camp, all things considered. A majority of the moves, though, have been concentrated in the bigger boys, which we're going to see in a second. Let's talk really quick about U.S. sectors on the 3-month and year-to-date. Leading in towards 2024, financials were actually leading. And as a matter of fact, going back 3 months, they're still within a leadership role, outperforming SPY and up 20.11% off of the mid-October area. Right now, tech is firmly in control, though. I shouldn't have to tell you that. If you've been trading the markets, you're invested in the markets, you know that the biggest tech names right now are at all-time highs. You have Microsoft, NVIDIA, AMD recently joined the all-time high list, etc. These things are screaming, but financials, kind of an underserved area of the market. Not a lot of people are looking at potentially owning these types of stocks. They have quietly outperformed over the last 3 months, and we're going to look at that in a second. Let's go ahead and pull up towards the year-to-date. Comms as well, really starting to outperform coming in towards this year. They had a great year last year, but because of the churn towards the end of year, comms got hit a little bit. Not only was it the big boys at the top, like Google and Meta, which did not necessarily get hit. They just stopped going up at the same pace as they were. But the telecoms got hit. Some of the social media companies got hit. But now we're seeing all-time highs in this particular space, most importantly within Google and Meta. So Google and Meta, I believe, constitute like 30-40% of the entire communications ETF, non-equal weighted. And right now, Google and Meta are both at all-time highs. So it only makes sense that the comm sector in particular is going to be up near all-time highs, which it is. It's not there yet. It's pretty close. But year-to-date so far, it is leading. T-Mobile as well, all-time highs. One of the telecom names, which is not what you would expect because Verizon and AT&T suck. Financials having an okay start to the year as well. They're starting to catch up speed. Let's talk about the underperformer here, healthcare. Still basing below its all-time highs, something that we expected that we're probably going to end up buying at some point this year. I expected it was going to happen within the last 2 weeks, and it just hasn't happened. We haven't pulled the trigger because we haven't seen the definitive breakout. And let's talk about the elephant in the room, Tesla's earnings. Absolutely tanking consumer discretionary. Did not expect that. Had no trade on it. I expected after a 21% pullback from the end of December that the market was pricing in some bad ER. I didn't hear it. I didn't read it. I don't really care. But apparently the market hated it so much that it continued to sell it off. So if you're a Tesla trader, specifically a day trader, I hope you made an absolute killing because there was definitely an opportunity there. Let's look at U.S. industries really quick, going back 3 months, if it's going to load. Koifin's being finicky today. I don't understand why it's not doing stuff. There we go. Okay, so going back 3 months, semiconductors, home builders, and regional banks. It's been the same 3 areas going back 6 months as well. Regional banks have had a really good last 6 months rebounding off of their financial crisis lows. If you remember that, we were supposed to have an end of the world scenario back in March or April of 2023, and it just never really played out, thank God. But here we got semiconductors leading. You have the biggest names, NVIDIA and AMD, obviously. You have regional banks that are starting to show, again, some vigor coming into 2024. They did get hit slightly at the beginning of the year, but they're starting to pop back up. CUBI, Key, etc., starting to break up and over key levels. Home builders still looking very good. It's a harder area of the market to trade. BLDR, AZEK, 2 names that we have positions in right now. But check out Jets. Not saying Jets is a great opportunity to own, but it's not bad to see one of the larger industrial-related industries within the industrial sector start to push upwards, right? Coming off of a stellar American Airlines earnings reports, most of the Jets names got a pop yesterday, and we see Jets now starting to outperform on the last 3 months. You have software and internet. It's generally the same group of stocks that we were looking at the end of 2023 that are still outperforming coming into 2024. Let's look at it really quick year to date. You have semiconductors, insurance, software, internet. I mean, that's it, right? It was like that all year last year. Can't imagine that's going to change anytime soon. We have a position in Allstate. That's at an all-time high right now, but insurance in general is at an all-time high. Semiconductors are at an all-time high. Software and internet doing absolutely incredible. Maybe a little bit of an opportunity there on some sort of pullback, right? We're talking about that. Speaking of pullbacks, let's go ahead and pull up our first Twitter post here from Mr. Jason Shapiro. Love this guy, contrarian. Follow him on Twitter at crowded_market_report. He asks, if Meta was down 76%, Apple was down 35%, Amazon down 54%, Nvidia down 66%, Netflix down 74%, and Google down 41%, would that be a big enough crash for you bears? Because that's what we called 2022. It already happened. And doesn't that just kind of encapsulate the doomsday preppers as a whole? I'm not saying stocks are never going to come back down, but if you weren't okay with this deep of a pullback in 2022, what else could you possibly want? It doesn't make sense. Markets don't typically double dip like this within a short time frame, talking a few couple years, okay? Specifically in that secular bull market idea that we've been talking about. So shout out Jason Shapiro, shout out the delusional bears that expect new lows in these mega cap names. Statistically, you're fighting a losing fight, but I pray that hopefully it works out for you eventually. Let's talk through a couple things in TradingView here. Let's start off with some breadth stuff. So the narrative right now is that breadth is just not really working that well, and it doesn't take a rocket scientist to look at some of the bigger names in the market right now are pulling the market up. You have Nvidia up at over $600. You have AMD, new all-time highs. Meta, new all-time highs. Microsoft, new all-time highs, right? These are the big boys pulling the index up. I get it. But breadth is not as bad as what people are talking about. And we're going to show it to you right here. As a matter of fact, right now, it's the morning. It's only 8:50. So this could change by the end of day here. But as of right now, 76% of the stocks in the S&P 500 are trading above their 50-day moving average. 76%, that's pretty goddamn good. Yeah, they might be pulling back. Yeah, they might be underperforming over the last week or two into all-time highs. But 76% are still trading above the 50-day moving average. Let's go ahead and look at the 200-day moving average really quick. 70% are moving above their 200-day moving average. That is an overwhelmingly large amount. That is not typically what you see in a super weak breadth environment. All right? It's just not what you would normally expect. I'm not saying that there's a shit ton of opportunity outside of the mega caps. Those are the things really moving right now. So from a trading perspective, maybe, from an opportunity cost point of view, that's probably where your money should be. But it's not the only thing that's moving. That's just not true mathematically. And we can look at it here by stocks above the 50 and the 200-day moving average. And let's talk about the Russell 3000. If you guys know the Russell 3000, this represents 98% of all U.S. domestic stocks. All-time highs yesterday. We closed. This is a representation of the U.S. domestic market. 98% of all stocks are owned within this ETF, and we're at all-time highs. That doesn't happen when breadth is absolutely terrible. Okay? Need to continue to point that out. Once again, mega caps are the place to be right now. Large caps are the place to be right now. A lot of opportunity there from a trading standpoint, but it's not the only thing working. So don't let people come in here and tell you breadth is so bad the market's about to crash. It's just not true. It's just, you can go and do the homework right now. Let's talk about the Dow Jones Industrial all-time high close all week. Once again, yesterday, all-time high close. We are expecting a very big move on the Dow over the course of the year, maybe over the next 18 months. The Dow is probably not going to go to a straight line to 42K, but we definitely expect it to. Let's talk about the divergence between the Dow Jones Industrial Average and the Dow Jones Transportation Average, some old school Dow theory here. If you think about this, Charles Dow, who was the creator of both of these indexes, said the averages, the industrial average represented the supply side and the transportation average represented the demand side. So does it make sense that the demand side in transportations might be lagging the supply side in the industrials? For most people, no, it doesn't make sense. But basic econ theory states that if there has been some sort of improvement of efficiency improvement in production, that potentially the cost of producing those goods has come down, and therefore those cheaper goods will eventually pass on towards the buyers and demand will increase and transportation will catch up. It is technically a yellow flag that the transportation average is not breaking out at the same price point as the industrial average, but it's not necessarily run for the hills. It's just basic econ. By the way, 6 years studying econ with 2 different degrees, and about 0 of it is helpful in the markets, at least from what we're doing from a technical standpoint. So kudos to my professors for robbing me. Let's talk really quick about the major indexes here. The Q's at all-time highs. You know, Q's at all-time highs, SPY's at all-time highs. Let's talk about the uncomfortable conversation about, do we expect a pullback? We do. Don't know when it's going to happen. Don't know if it's going to happen next week. Don't know if it's going to happen the first week of February. I have no idea when it's going to happen. But I will tell you, if we bring this into a candlestick chart, these types of moves through all-time highs are common. Generally, you get a short squeeze and everybody else that's loading shorts there, puts and everything else. You get a violent move to the upside. But typically, we're going to get a throwback. We're going to get a move back, potentially down towards the all-time high, or maybe even undercut it before we come back up. We saw it in 2020. We saw it the previous time as well. You can see the all-time high break and then a pullback and then the pop back up. You can see it in the Qs as well. Go back to 2020. Go ahead and zoom in here so you guys can see. You get the breakout, awesome breakout, then the pullback, then the resummation of the uptrend. This is a basic BRB concept. If you guys are privy to anything that we talk about, we like buying the pullbacks across horizontal levels that make sense to us. We do expect it to happen. We do expect that the market is going to pull back and it's going to strand everybody that's chasing up here. It's really, you know, people, who would buy companies at all-time highs? That's how trends work. People buy all-time highs all the time. It's not necessarily a disadvantage, especially if you're catching the next leg up. I mean, this is basic trend following behavior. But it's very important to understand that uptrends don't just go like this. They're going to oscillate. A staircase, essentially. We do expect the staircase back down towards overhead supply, which we will be looking to buy, right? Just need to point that out. Start prepping for it. Maybe this is not the environment to be pressing your foot down on the pedal a million miles an hour by everything under the sun. Just be a little cautious here. We're expecting a pullback. We are going to buy the pullback in assets that are also pulling back to horizontal levels, sitting at about 60% cash right now, 40% vested. I'm excited for the pullback, which sounds crazy because I'm very bullish this year, but I think it needs to happen. I definitely think that there's a lot of frothiness in the market, which we're going to talk about in a second. And I think that a pullback in towards those levels is going to bring that fear. Everybody's going to freak out. The world's ending, double top, sell everything. And then just like classic market at all-time high action, we're going to continue the uptrend just as soon as everybody sells all of their shit or starts to short the top for the next generational low that we know, if you have a couple brain cells, is probably not coming this year. Let's talk equal weighted stuff really quick. QQEW, let's go back to the line charts a little bit easier on these thinly traded or less liquid ETFs, I should say, not necessarily thinly traded, but QQEW is sitting almost at all-time highs. This is an equal weight representation of the NASDAQ. So it's not just the big boys at the top. The entirety of the NASDAQ is working very well. We can also look at that from a S&P 500 standpoint, ticker RSP. This is your equal weight S&P 500. Not necessarily at all-time highs, but sure looks okay. Looks like we're about to break out into 1.5-year highs, right? So once again, breadth is not as bad as what people think. IWM, the one area of the market that I'm bummed about. I want this thing back up and over 198.5. We do think it's going to be there, right? The RSI came down, oscillated off of the 50 and started to bounce. That's the beginning of a potential bullish momentum regime. We're going to get vested again above 198.5/200. We're holding off right now. I have dedicated about 10 to 20% of my portfolio, like the cash itself that I have right now, to be buying some smalls and mids when IWM breaks back up and over 198.5. It's just not there yet. We're remaining very patient. Potential little inverse head and shoulders that I'm just seeing right now. Pop, 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 pop. It's simple, man. Shapes are simple. But realistically, above 198.5, I'm going to start looking to buy stuff again. I really like the RSI momentum resetting at that 50 area. If you know anything about momentum, RSI resetting at 50 or 40, once it's already up and over that area, is very bullish. So I like that. Let's talk really quick about tech, all-time highs. Let's talk about semiconductors really quick, all-time highs. This is the leading industry group. Big boys at the top, NVIDIA and AMD. But it's not just those. TSM came out with an awesome earnings report. You have AMAT. You have Marvell. I mean, all of the semiconductors are looking pretty goddamn good right now. Do think this is a frothy area of the market. Do think there's going to be a nasty pullback, but the resummation of the uptrend will probably occur, and this will probably be one of the leading, if not the leading industry group once again in 2024. It has that feeling, but it is frothy. We do expect this to be whipsaw. We do expect people to feel like they got burned buying the all-time high, and it's going to turn them to bears forever, and that's what we want. It's more liquidity to the upside. So we're not stupid. We're not buying here, but shout out to the guys in the AMD play that we bought back here. This is a 600% trade right now, and it's free. Congratulations. We also bought here, turned it free the second day by selling some put credit spreads that were up 65% the very next day, completely funded the long side of the trade. It's pure profit at this point, and we have 6 months, 7 months left on these trades. So this feels very, very good to be long this, but we are expecting some sort of pullback. Stock Financials really quick. Financials 1.5-year high. This is an area of the market, once again, that nobody's really talking about. Everyone's afraid. You have monetary policy that's shifting in March. Everyone's talking about banks are going to go under again. I don't know. I mean, maybe, but having this information in the back of your mind, why the hell are people still buying banks? Not people, by the way. This is financial institutions buying banks. It's not retail. Retail doesn't move stuff like this. So if they're really afraid that something's going to happen in March, tell me why they're still buying this shit. It doesn't make sense. The trend is up. We're into 1.5-year highs. We like this, and it's being, led by JP Morgan, a trade that I'm in right now, 1.75R. So God bless my heart. This thing is starting to break back out, and maybe I'm not going to lose a goddamn trade. But it feels good. JP Morgan is the flagship name in the financial sector. This is the name that leads. It has very high correlation to the overall S&P 500. And as of right now, Friday morning, we are capping up into all-time highs, so that's nice to see. Two more charts here. Going to go super quick. We're worried about bonds. If we break below 92, that is a yellow flag for stocks. The bond correlation between stocks and equities is very, very high right now. Generally, the bond market leads the direction of which way these two asset classes move. Bonds have diverged from stocks. Stocks are at all-time highs, whereas bonds have drew down 7% since the end of December. We're just very cautious about this. If TLT breaks below 92, we are breaking back down at previous support, turned resistance, turned support. And that's not great for equities. If this positive correlation continues, which we expect it to, and the dollar dancing around the 200-day moving average. Every time the dollar pops up and over the 200-day moving average, stocks tend to start fluttering around, potentially pulling back. Right now, this entire week, actually, if we bring it to the candlestick chart, you can see for the last week and a half, we've danced around this 200-day moving average. Every time the dollar is over the 200-day, stocks are down. Every time the dollar is under the 200-day, stocks are up. Inversely correlated, we expect this to continue as well. I expect, and I'm not trading this, but I expect the dollar to continue to the downside and potentially take out that 100 area. If we take out that 100 area, this primary uptrend that is in place still is threatened and potentially breaking down. And if that's the case, that's the juice we need to send equities to really the stratosphere. If the dollar really breaks down, it's a basic, binary decision. Do investors and traders want to own dollars, or do they want to own equities or bonds? But bonds and equities are moving in the same direction, right? So if the dollar's breaking down, where else are people moving their money? It's probably going to be in stocks. It's probably going to be in bonds, and that's exactly what we want. Okay, let's talk two more charts really quick to finish this off on Twitter. Nautilus Research, of course, you guys have seen me harping about this for the last month now, but they put out this really awesome chart here showing you the 4-year U.S. presidential cycle. Look at that 2024. Look at that 2024 election year. That is a very good year on average. A very, very good year on average. So I'm sitting here talking about brace for the pullback, but we are buying the pullback with the assumption that we are going to have an incredible 2024. We reserve the right to be wrong. We have absolutely no problem being wrong. I'm wrong all the time. I'm the dipshit that bought PayPal a couple days ago because of the technicals, not because of what the CEO said, and I got stopped out yesterday. So I lose trades all the time. I have no problem being wrong, but 2024 statistically is going to be a hell of a good year. But let's talk about February really quick. Mr. Stock Trader's Almanac himself, Jeffrey Hirsch, shows that February is the weak link within this 6-month run of relatively good performance. Generally, midway through February, we do see a pullback. Could that be the potential area, statistically speaking, that the indexes pull back towards their all-time highs? Maybe. This goes back 20 years worth of data in February showing that this is kind of the weak link. So if we're thinking about this really quick from a trading view standpoint, let's go to any of the major indexes. Does it make sense that maybe in February we see this pullback towards the all-time high? And should that be a buyable dip? Well, we say yes based off of TA, but also if you think about the statistical edge of being long in 2024, you can see the pullback comes in February and then we see the rocket ship. So probably not a bad idea to own stocks and be buying stocks during that pullback. Guys, my name is Hamilton. I'm here at the Trading Initiative. Please like and subscribe. Comment below if you like this type of content, and I'll catch you in the next one.